So the next, I would like to invite our next speaker. He is Mr. Dhirendra Kumar. He's CEO Value Research. And I would like to invite you, sir, for sharing a wonderful presentation on reviewing clients' mutual fund portfolio, which I'm sure a very awaited topic for all the financial advisors present here today. Over to you, sir.
Thank you. I don't have a presentation, but I have some outline of or a framework of what I want to speak. And this is primarily, derived from all our experiences of all the mails and letters which I get at Value Research. Value Research has been a very interactive organization where a lot of real users ask questions, and we try and answer them through our product or our content. So, this is something which, we have been doing in a reasonably formalized manner over the last 18 years. We launched the Mutual Fund Insight magazine, and there is something where, a feature which is carried every month, and that where one of the investor will be sending his question relating to his portfolio, and he will list his set of questions, and we'll try and answer that. During these in the course of answering those questions, in the last 18 years, we have evolved. We came across all the embarrassing answers which we gave, and the learning from there. Many a times, 18 years ago, things were a little different in terms that, I remember our first mutual fund insight issue, where we recommended that, for your long-term investment, one should have equity. And we got so much of disenchantment, or so much of angry mail, because that was the time, last 5-7 years, investors believe in recent performance or chasing recent performance. That was the time when everybody believed debt funds were actually giving equity kind of returns, and equity funds were almost dead. They were posting negative return after the Y2K crisis and all that. Debt funds, we had that historic, rate cuts, successive rate cuts coming down from 14 to 8%, that translated into a substantial return. So there was complete disbelief in equity. So an opinion being given, which was based on sound principle, with the understanding that why equity works in the long run. But there were not too many takers, and that I think is a huge opportunity right now. And you have this opportunity all the time. You have this opportunity. There has not been a single day. A lot of people, when we get a question, everybody says that right now the market is very volatile. Market has always been volatile, and managing that, and there has not been, people's definition of volatile is a little different. They have actually converted that volatility as a decline in market is being politely or gently told as volatility. Volatility is something which goes up and down, violently. And markets are always volatile, but I would like to just give you an outline of the framework in terms of how to review the client's mutual fund portfolio. Get back to basics, match the goals. You can choose the finest investment, and if they are not the suited ones, it won't work. Risk assessment. This is where I think there is substantial difference. Regulations say that you have to do the risk assessment necessarily in a certain format. Of course, you should, but I think that is not as much useful. Based on all this interaction with investors, we find that at Value Research we look at 3 variables very intensely, very closely, and I think without that, all your advice will go waste, because at a certain level, it is also expectations management. If you have, if your investors have certain expectations, and if they are not met, your finest advice, which will work for him, he will not stick around, and he will be deprived of the opportunity. To our understanding, these 3 things are scale. 5 lakh rupee could be very substantial money for somebody, and 5 lakh rupee could be a daily swing for somebody, which will not be material. So how important it is, this is very crucial. Next comes experience, and this has to be, if somebody has experienced 2008, his behavior to market, or a market linked investment will be very different. If somebody has experienced 2002 as well, it will be completely different. If somebody has been invested in equity for the last 15 years, it will be very different. Somebody who came 1.5 years ago And I come across a lot of hate mail right now that mutual fund sahi hai was a misleading campaign. It is not. In fact, somebody is actually right now putting on my Twitter timeline that mutual fund sahi hai. You should say that mutual fund sahi hai with all these riders. Otherwise, it is misleading. That is perhaps because his expectations were set in a manner which are not being met. And then tentative time to goal. This is a very precise fundamental thing. And there, a lot of people, you would have experienced it much more, but I come across once in a while. Across the table, I don't meet too many investors, but I get a sense that everybody is investing for the long run, but they want their investment to work continually in the short run as well. So this is something, because that is the ideal expectation. I would, as an investor, I would like to have an investment which gives me the highest possible return in the most sustained manner with the least possible risk. But that is somehow not possible. So you can only have, you can only reinforce certain principles. And there, I think, having that basic tenet that you should have diversification in a very meaningful way. You need to be a real strong believer. Many a times the expectation is raised that you have to really beat the market. You have to really become impressive. You have to look nice on an ongoing basis. Not really. If you can actually give somebody a framework and somebody starts believing you, and that will happen only over a period of time. I think you need to just set the expectation, right? Work little more intensely on the numbers, the pluses and minuses of any strategy. Choosing the appropriate investment class. I think this is where many disappointments, or the root of disappointment lies. The appropriateness of an asset class, or the appropriateness of an investment vehicle chosen for that investor. And then diversification. Now it is possible to easily diversify beyond your investments in India. I think is has really added a completely new dimension, and it should be on the top. It should be very prominently in your thought process. Then comes the liquidity, because that is entirely dependent on. So getting back to basics, I don't think, while not violating these basic tenets at all times is very crucial. And beyond this, the basic sequence of savings that is, and this can actually be for a very wealthy individual. This could be for a very very wealthy family, or it could be for a lowly person, lower middle class as well. It works for everybody. But I don't think the sequence of the savings, investment savings hierarchy or sequence or the order changes. Emergency money, it should be there. The scale will change depending on the person. Tax saving, all your investment should be tax efficient, so that tax saved is money earned. And mutual funds do present a special opportunity that till you realize again you are not liable for any gain. I think that is something which is very underrated. Is not being talked about as much. And then a tax efficient vehicle. A mutual fund makes all the changes in the underlying investment, and you are not liable for any of those gains and losses created within the fund till you realize it. So these are two critical advantages which we don't talk about as much. And of course, classifying your investment for the short term, medium term, long term, or retirement, or leaving a larger state. These are broader goals. So this sequence cannot change. I don't think you can think of tax saving or short or medium term before you have that emergency fund, and that could be applicable on a different scale for different people. And of course, somebody in the previous session was talking about looking at the liability side. In fact, that liability side for a wealthy individual could be very significant. We have seen people where we look at the assets and we get very impressed, but when you look at the liabilities, it suddenly becomes not so impressive. And then getting a holistic picture, and that is not something which will come easily. This is something which is a reward of gaining somebody's trust in a manner where one is open to, because all investors want good advice, but they are unlikely to be sharing all the information which will translate or which will ensure that one is getting a good advice. So I would say that be very it will take some time, build it up, and that can be done with a meaningful framework which is communicated to them with clarity. Now, fixing the basic problems in the basics, reviewing clients' mutual fund portfolio, investors chase recent performance. It depends on, who is the investor, who is your client. If he's a new client and is coming with already having a portfolio, which normally is the case, then how do you go about fixing it? It can have a lot of things which are inappropriate. It could just be a collection of funds built over a period of time. There could be a great fund where they had, there could be a variety of problems in that. And how to simplify his portfolio, how to bring the focus back, how to align it with his goals, that's a different story altogether. Another crucial thing is that, a good investment and will become an inappropriate investment. If your needs change, then, the great investment of last year may not be the suited investment. And that, getting a sense of that with clarity. Likewise, life moves on and, your family structure changes, your personal circumstances changes, or, professional or personal circumstances changes. You need to really change it. You need to really alter. A growth portfolio will immediately, there could be a need that it could, the need changes very quickly to an income producing portfolio while it was an accumulation portfolio. And mutual fund is a great vehicle in terms of, converting your small cash flows into a capital and, deriving income from a cash flow. So from a capital. So, this is, and the 3-4, simple things, SIPs and SWPs and STPs for investing a large amount of money and spreading it over a period of time and choosing a good portfolio. These are simple vehicles the simple tools to implement. The most crucial thing, I think, your expectation will be that reviewing clients' mutual fund portfolio, your expectation from me will be, how to identify, how to spot the losers. Spotting losers is very difficult because our losers normally have we have a sense of the losers simply because they have done poorly. And that may not be the appropriate way to look at it. There could be a category where all the funds are losing money and all the funds are good and all the funds needs to be retained simply because, the weather has changed or something. Understanding this requires judgment. This requires judgment based on a premise. And this I think requires, I would say, a thought process, which will deprive you, because spotting your losers and spotting an underperforming investment, which is not a loser, is the crucial difference, because you could have done all the waiting and you sell your investment just before there, because reversion to mean is a reality. Reversion to mean we see all the time. Reversion to mean we see in all kind of investments as well, or class of investment, or the category of investment, or a sector, or a segment of the market. So this is truth. And losing your patience at the inappropriate time, making sure that you are, and that is something where you have to, build your foundations in a manner, diversification in a manner, that your portfolio represents different style depending on the scale. And you will not have the crisis of the kind if you take a holistic look at your portfolio. Finest of choices, go up and down. Poor performance could be a temporary thing. It could be an illusion sometimes. Sometimes it could linger. Sometimes it could linger for a logical reason. Sometimes but the investments could be very good. And I think this is where your broad-based understanding of the market. Also the investor, because an investor who will panic at a certain scale of volatility or underperformance, they need to be they need a slightly different asset allocation maybe. Revisiting all that, depending on your conversation, making a judgment about your investor as well as the investments made on his behalf. I think that is something which is a subjective thing, and this is where I think a one-to-one interaction, understanding the investors well, can pay a very significant payoff. And but there are real losers, and that is something which we need to really spot. And real losers, I would cite some examples. And there are quality investments which turn out to be losers for a long period of time. For example, somebody bought Infosys and that investment did not work for next 10 years, though it remained a great company for next 10 years during that period. That was, if somebody bought it in 2002, it remained like that. Likewise, in 2008, most of you will recall that, infrastructure was a rage. Everybody was buying the BHEL and L&T, and they were growing at 15-20%, return on equity, which was backed by stock prices followed. And now we find that, it turned out to be, those days are not coming back. Infrastructure funds continued. Investors remained invested in hope of, that they will make a comeback. They never made a comeback. And this is where I think, it was, so differentiating an investment between, a story and what should be the exposure. Maybe it is very difficult to resist the temptation of not riding a boom of that kind. But how you should be riding it, persuading your investors that, why you should not ride it with a narrow vehicle. If there is an opportunity, why your broad-based vehicle you can ride it through them. And at least those funds will have the flexibility of keeping away. Here, these funds will not have the opportunity of, drifting from that, because that is a clear mandate. They are supposed to be in infrastructure stocks only. So you see a loser remain a loser simply because it was a narrow mandate. A broader, mandate would have been better. So how to persuade your investor, and in good times, you are simply saying that, we don't want to ride this, boom which looks unreal. Now, this is something which, you will be faced with this question all the time. And I don't think there is an answer. We also face this question all the time. The obsession with the best performing fund, it is very difficult to guess. All you can do is you can anticipate that these are funds which could be, which could be good, which could be above average, but will it be the best fund? And maybe, my broader sense is that if you get lucky with the best fund, and because finding a best fund, after you have, the best fund should be the fund which remains the best fund after you have bought it. If it was just last year's best fund, it is no good, because that is all past performance. So how do you go about doing it? I think, there is no way of doing it. I would say that be wary of the best fund, because on most occasions, the best fund would have, its performance could be attributed to assuming a risk which you are not prepared for, which you may not be prepared for. It could, I don't know, many a times it could be luck. Many a times, I really wonder that, best performance can be a strategy. Best performance, a good performance can be a strategy. And good performance by strategy will also mean some intermittent bad years. I really wonder that, one can do it with, it can be done with conformity. So don't be obsessed with that. Only, one fund out of 100 is at the top. And trying to spot that top is a very misleading thing. A reversion to mean that, chasing past performance is almost guaranteed to be a, losing strategy. I remember, one situation that Sunil Gavaskar was, commenting in course of his commentary that India was playing against England, and Nazir Hussain, the captain, an Indian batsman will, score a four, or will hit a boundary at a certain position, and then Nazir Hussain will place a fielder there. The next time Sachin Tendulkar will actually, hit at some other point, then he'll move another player there. So, if you go about chasing the best performance, it'll happen like this. You will become the Nazir Hussain, and something else will happen elsewhere. And it's very difficult to anticipate that. Don't repeat that. Choose a good fund. Have a premise that, you are eliminating, and choosing a good fund is pretty simple. If you are able to eliminate the likely bad fund, that itself is good enough. Then rest of it entirely depends on somebody getting lucky as well, belief in that process, and consistency of process. Because if you're not getting surprises, nasty surprises in terms of the fund manager leaving and somebody else making things differently, or a big churn in the portfolio thoughtlessly, those are things which I really fear. So this is all that I have to say, and these are key points. And I don't think one should look at it in terms of today the tools and tools and methods available. The information has been democratized. Today you also have very sophisticated vehicles which enable you participation or diversification or convenience with great simplicity. It was not possible 10 years ago that if somebody can build a portfolio, a portfolio which one has accumulated, and mounting a withdrawal plan on that with conformity, a flexible orientation or flexibility in the withdrawal every year, making it tax efficient depending on what part of your investment is being. You can get selective and make it even more tax efficient by choosing your investment from where to withdraw. So harnessing the entitlement of 1 lakh rupee capital gains that one can avail in a large accumulation portfolio, old accumulation portfolio, it could be quite meaningful. So get going with this, and I don't think one should try and make it like a black box. It could be a very transparent thing, and devising a transparent methodology, a process, and communicating it to investors, your clients, and be very clear about what you help them do and what you will actually strongly discourage them to do, and that is your value addition, and sticking to it, arguing it, persuading them. That I think is the business, and setting the expectations right, and being committed to following this framework at all times is the strong value addition. And that is what a wealth advisor, a trusted wealth advisor brings on the table. So thank you very much for giving this opportunity to share all the things that I have learned at Value Research over time.